As I mentioned earlier, the NSE under pressure in today's session, down 0.6%. Yesterday we saw markets gaining 0.25%. We had that interest rate cut yesterday, and it seems that most investors still waiting for those numbers to start filtering through in terms of corporate earnings.
Yeah, that's true. We expect for especially for banks and some commodity-linked stocks, for example, the tea-based stocks or coffee-based, will record higher revenues and therefore and higher profits as well. So that should give some impetus to market. Well, actually, I thought that the interest rate cut should help boost that, but that would take some time to filter through, I guess.
Well, Johnson, let's touch on the interest rate environment currently, that's taking place in Kenya. As I mentioned, 25 basis point cut. We're sitting at 5.75%. One of the things that we have heard over the last couple of sessions is that perhaps the central bank is trying to bring down the cost of government borrowing. Is this what you're hearing as well? And do you think it's going to have the desired effect?
Well, I would have thought the argument would have been to bring down the interest rates costs, which I know is a concern, given that they need to borrow quite a bit going forward to finance not just this not just this budget, but the coming budget as well, owing to the fact that we have done we need to implement the new constitution, which will involve some money. Whether that will be achieved or not, I'm skeptical, given the inflationary pressures just from even higher commodity prices. For example, oil. Remember, Kenya is a net importing country, so the cost of imports, which are usually oil and capital goods, will go up for companies, and that might put some headwinds when it comes to investments. And you know what that means for economic growth. So I'm not too sure. The government is walking a tightrope here. I think at some point they will probably be forced to implement some austerity measures.
Well, Johnson, it's interesting that you mentioned the high growth scenario, that perhaps it could be at risk if we do see a very high inflation coming to the fore, as you mentioned, Kenya being a net importer. In the central bank's statement yesterday, well, the MPC statement yesterday, it did say that high inflation or high growth is going to counteract higher inflation. I'm hearing more cautiousness coming from your end, and you're talking about tightening going forward. When do you think that could possibly happen?
Okay, for the first quarter of the year, probably things might go on as planned, but as we move forward, unless we see significant trend, which may or may not mitigate the inflation coming through from imported inflation. But then again, you have to take into account that in Kenya we've also been seeing our fair share of stimulus, and we can see how that's working out for Europe and US. I have no reason to believe that it will work out any different in Kenya. So inflation might be a story both imported and internally generated. So, but of course it remains to be seen as we move forward.
Well, just looking at the interest rate environment as well and bond yields, it's quite interesting to note that since the end of last year, it seems that the markets were pricing in an interest rate hike, and it seems that some are of the view that the central bank and the MPC committee wanted to allay fears of monetary policy tightening, and this is also why they decided to cut rates. Looking at the yield environment going forward in Kenya, how do you expect this rate cut to impact possible yield movements going forward?
Well, I would think that the banks might offer some resistance to a downward trend in interest rates. They may be forced to because of the level of liquidity in the market, but I certainly know that they'll offer some resistance in anticipation of higher yields, because they know the government needs to borrow to finance its budget. So we might be watching at a stare down here between the banks and the government. I'm not too sure that the government has too many tools to control interest rates. But we will see as time moves forward.
Okay, Johnson, well, just touching on how the banks are going to respond. As you mentioned, perhaps they're going to be relatively reluctant. We know that the central bank's repo rate and what we see on the lending rate front from the banks is definitely no alignment there in comparison to what we see in other developing markets such as South Africa and the developed world as well. Do you think that we'll ever see an alignment with the retailers or the retail banks' lending rates and the central bank's repo rate?
Perhaps there's something we're missing. If you're seeing non-alignment or a lack of correlation with the two variables, perhaps there's something we're missing out here, and maybe we need to look at that more deeply. Perhaps the asset quality does not allow them to manage the rates the way we expect them to, given the environment we are currently in. But that there's an initiative that has been taken on by central bank, that the Credit Reference Bureau, where the banks are able to share the interest rate, information on borrowers, and perhaps that could shed a bit more light on how they should be able to tackle the problem of multiple defaulters. But other than that, so I tend to think that it's the asset quality that does not allow them to align the rates does not allow them to play the rates the same way that foreign markets do.
Fantastic. Thank you so much, Johnson, for joining us today. Much appreciated.